Hello people! Welcome to the Real Estate Real Talk YouTube channel. House flippers have had a profitable few years because of low interest rates and rapidly increasing home prices. It was almost impossible to not make them money. However, recent interest rates have ended the housing market and buyers are no longer interested in making purchases. Buyers cannot afford their dream home anymore, so they prefer to wait until more favorable interest rates return before completing a purchase. If you want more real estate content Real Talker, subscribe to the Real Estate Real Talk YouTube channel and hit the notification bell. After the change, those who engaged in flipping strategies are left stranded. Here are some strategies that could help you ride the lull out. Focus on the turnkey investment properties. As markets turn and potential buyers are priced out of purchasing homes, the rental market surges, with savvy owners from 2008 able to evolve into real estate investors. During the last downturn in 2008, flippers adopted a strategy by renovating single-family homes and duplexes for investors looking for monthly cash flow. This strategy is a win-win because it enables landlords to increase their monthly income by taking advantage of short-term real estate. This helps maintain a monthly cash flow for landlords until they sell their assets. Rehab multifamily homes for owner-occupants. Buyers who are unable to meet qualifications for a single-family home may be able to qualify with a duplex, triplex, or fourplex. Both house owners and renters can live on the same property to save money on mortgage payments. This practice is known as house hacking. When the market is ready, owners can rent out their multifamily properties, comfortably qualifying for a home loan with a low down payment. FHA loans are adjusted to reflect this change in debt requirements for homeowners of rental property. Scale up to multi-unit buildings. When the rental market is hot, many house flippers should consider increasing their portfolio. With a larger building, they can add value to each individual property through upgrades and repairs. As a result, the rent roll will increase and the longer-term profitability of each property will be boosted. Downsize to flip less expensive homes. When a market cools, the upper class of homes becomes unaffordable for many buyers because these owners are paying more in taxes. Flippers should avoid them because lenders might be more cautious to give out loans in order to flip these expensive homes. Now is still a good time to purchase a renovated property that's median priced. If you prefer renting over a mortgage and are used to flipping homes for big profits, now would be a good time to sell your McMansion and move into a smaller house. Look to prehab properties for quick cash. You can work with flippers to minimize the risk and profit on your property, while you sell or rent their properties on their behalf. In return, you can make money on the side by working for a day job until you can afford your next property. Business-wise, you can offer to provide services like title issues, COs, and removing debris from properties so the buyer gets all their money back by focusing on flipping the property themselves, all the while saving time and money. This relatively inexpensive process can earn a newbie flipper several thousands of dollars without incurring the expense and risk of a flip. You can find desirable properties by looking at foreclosure and auction sites where you can snap up distressed real estate for a few $1,000s. Search for expired listings that didn't sell. The sellers in a changing market have had a hard time adjusting to their inflated home price, often getting just one offer on their listing for the lead buyer. This can mean huge losses for sellers when their dream property isn't sold quickly and they are left struggling with regrets of purchasing it at the inflated price. It is important to check expired listings on the MLS that are still going strong so you can fetch buyers at current market conditions with an offer lower than what the house was listed for originally. Negotiate with homeowners caught in a chain. If they find out that their home will sell quickly, homeowners who are ready to move may lose money waiting for their current property to be sold. This could mean financial penalties, which can affect them in the long term. Oftentimes, when inventory dries up in a cooling market, it means that buyers have more leverage than sellers. This can lead to negotiation of a reduced price or other pre-negotiated agreement. Wait until the reality of a new market settles in to negotiate. Interest rates are expected to increase, which is likely to create less demand for homes in many areas. This could mean increased competition, and sellers will likely to be desperate to offload their properties, especially those with adjustable rate mortgages due to the decrease in people buying. So it might be worth waiting a few months before investing again with better potential profits. Refinance and look to bridge the gap. If you've taken out hard money loans to purchase real estate, it might be time to take a reality check. You can refinance these loans to potentially save a lot of money. In this case, There are 3 popular strategies to consider once you've refinanced and anticipate holding on to your flips. Renting your home to a long-term tenant is the perfect financial move. List your home on Airbnb and sell it quickly so you can turn rental into profits. If the tenant cannot qualify for a mortgage, you can buy their home at a mutually agreed-upon price. Despite an increase in mortgage rates, home prices have continued to rise because there is not a presence in the housing market. The economists predict that the cost of homes will stay high for the next 2 years. For now, 2020 and 2021 seem like good bets for purchases, but that could change with a crash in 2022. Home prices increased dramatically starting in 2015 during the COVID epidemic from excess demand and low supply. Mortgage rates plummeted, causing a rapid increase in home ownership costs. However, housing market trends show that we may see downward pressure in the next couple of years. Nevertheless, buyers remain interested and competitive, which benefits everyone as they pay more and could lead to new records being set for home selling speeds and price increases. Despite clear indicators pointing towards slowing housing market activity, housing remains competitive, with the recent record set for home selling speed, price increases, and investor attention becoming more focused on rentals. Home mortgage costs and concerns of a recession have caused housing markets to be at a low point. Economically weaker areas that have seen explosive price growth in the recent years on the West Coast are seeing some of the first signs of cooling demand. Buyers still face competition, as multiple offers and final sale prices are higher than asking prices. In regards to the market, sellers are losing steam as buyers continue to decline. As a result, pressure from home price growth will remain in place through the end of 2022, and housing prices will still rise. This is due to mismatch between supply and demand, as many experts predicted that the pandemic would cause a housing crash like the Great Depression. That forecast is not accurate, as house prices are not expected to drop even in the second half of 2022. Rather, they are forecasted to rise more slowly than last year. In 2022, the housing market was much better today than it was a decade ago. The housing industry has had a boom last year, with the most significant annual gain in single-family house values and rentals, historically low foreclosure rates, and the highest number of home sales in 15 years. National home prices have increased 33% over the previous 2 years. The housing market has flourished in recent years because of record low borrowing rates, a constrained supply, as well as overbuilding. The significant demand from first-time homeowners is providing keen interest as well. Moreover, the nation's exceptionally favorable demographics are key motivators for today's housing market. Goldman Sachs analysts published a study on August 30, 2018, titled "The Housing Downturn: Further to Fall." The investment bank now predicts that activity in the U.S. housing market will be down by the end of 2022. This year, the business predicts steep reductions in new home sales 22%, existing home sales 17%, and housing GDP 8.9%. Goldman Sachs projects further declines in 2023 in new home sales, another 8% drop, existing home sales, another 14% drop, and housing GDP, another 9.2% drop. According to Black Knight, a mortgage software, data and analytics firm, prices in the home have fallen by 0.77% in July. Despite this extreme drop in costs of homes, it is the worst result since 1991. Though home prices are higher than they were a year ago, mortgage interest rates have increased and is affecting home sales. Home sales volumes will decrease in the second half of 2022 and entire 2023. Historical data shows that home sales could fall by as much as 15%. Higher employment rates, rising ARMs for cash buyers, and a higher number of cash buyers are expected to help offset any short-term market impact. The market will not be able to remain as balanced as it has been, as inventory drops and interest rates climb. Because lower price tiers are more susceptible to interest rate hikes than higher price tiers, they will see less demand, while the number of homes selling decreases. This may change the size and mix of homes on the market. Freddie Mac estimates that there are 6 million more first-time home buyers between the ages of 25 and 34, with an additional 3.1 million high-income renters between those ages who can afford to buy a home. In 2006, lending criteria were loosened, and there was low scrutiny of the borrower's ability to repay the loan. Nowadays, the requirements are more stringent, which lowers the risk for both the lenders and borrowers. In a challenging housing market for buyers, the share of buyers that faced at least one mortgage denial before being approved grew from 22% in 2020 to 34% in 2021. The Mortgage Credit Availability Index, or MCAI, released by the Mortgage Bankers Association, measure how easy it is to get a mortgage. Compared to the previous month, two different housing markets eased significantly: the government and jumbo segments. These two segments are not comparable to one another, since the current situation under inspection does not resemble that of the past. As the real estate market slowed, loans became harder to get, and then in 2006, 400 made it difficult to get a mortgage loan. Mortgage availability fell as a result. Fortunately, the conditions of lending have eased a little bit since 2006 pandemic. The index was reading 120.0 in May 2017, which is nearly 1/7 of what it was before the pandemic. Housing market activity in the US hasn't yet reached pre-pandemic levels, and a lot of people are having a hard time finding the house of their dreams because there aren't as many options available in the market. Many communities are struggling with low inventories. On the other hand, millions of millennials are taking advantage of home buying opportunities in a growing market. However, chronic underbuilding and a shortage over the past decade have resulted in a mismatch in housing supply and demand. Even though mortgage rates are at an all-time high, the housing market is not going to crash anytime soon. In the next 5 years, we have predicted that housing will appreciate at a slower rate because of certain factors. This pattern should be accounted for in real estate beyond 1 year. CoreLogic HPI scores homes based on data from and point-of-sale or POS transactions, taking into account the number of sales, average price per square foot, and growth in consecutive months. With home prices slowing downward for the second month in a row, this indicator presents early evidence that a housing market slowdown is nigh. Prices increased by 18.3% in the year following June 2021 to June 2022, with only 125 months being recorded with year-over-year growth. This value remained strong, but slowed from the previous month, as evidence of lower buyer demand caused in part by higher mortgage rates and concerns about a slowing economy. On a month-over-month basis, home prices are increasing by 0.6% in June 2022 and will continue to increase with an expected rate of 0.6% from June 22, 2022 to July 2, 2022, as well as a year-over-year basis by 4.3% from June 2022-2023 to June 22, 2024. Nationally, home prices increased about 18% year-over-year in June 2022. Only one state experienced a decline in home prices. The states with the highest increase were Florida, 31.8%, Tennessee, 25.8%, and Arizona, 24.9%. Large cities continue to experience price increases in June, with Phoenix on top at 26.1%, followed by Las Vegas at 24.3% year-over-year. The U.S. CoreLogic S&P Case-Shiller Index dropped from a 20.6% gain in April to a 19.7% increase, as the market slows after strong reacceleration early in the year. May saw significant gains from the previous year, following a survey that showed fears of an impending recession. Mortgage rates were higher, and this impacted buyers in the form of caution about their purchases. Overall, sales were fairly constant from 2018 to 2020. Price declines are accelerating in many markets, including those that saw price hikes over the last 2 years, such as California's coastal markets and Phoenix. June looked like a turning point for this decline. CoreLogic's S&P Case-Shiller Index reported significant drop in buyer interest. Even though the housing market is cooling, it's not enough. After 2 record years, the housing market remains difficult for buyers, who now face competition and pay premiums for attractive properties. The 10 and 20 city composite indexes also showed signs of losing speed, up by 19% and 20.5% year-over-year respectively, rather than 19.6% and 21.2%. tourists are moving to smaller markets in the Southeast and Florida since they have a more affordable price point. Freddie Mac's home price growth argument depends on the belief that we can't see how mortgage rates affect homes. Freddie's own study showed that a 1% increase in rates is necessary to offset home prices 4 percentage points. However, JP Morgan has found that reducing the number of mortgage payments by 6 percentage points will create even further drops in housing values. That's it for this video, Real Talker. Remember to subscribe to our channel. And if you feel like we've delivered value, please share this video with one person. That's right, just one person. As a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!